In this video, I want to introduce the concept of pairs trading as a potential risk mitigation strategy in a toolbox of investment strategies that might help somebody navigate the current slightly volatile conditions in the market. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder and have been investing for over 20 years. I've created this channel to share my techniques, thought processes, strategies that I use to manage my own money, many of which are not probably that common, as this video may be one example of that. So I hope you enjoy. But before we jump into the details of this video, I do want to mention that the topic of today's video is by no means without risk. In fact, it really should be reserved for the people who are very advanced, very seasoned investors that know exactly what they're doing. This is by no means a recommendation or a suggestion on what anybody should do. In fact, I think before even considering this type of strategy, if you've never entered into something like this before, you better contact your own professional financial advisor or otherwise to help you manage and I guess navigate your way through a strategy like this if you do intend on trying this for yourself. So just wanted to warn you right now before we jump into things. So first, just to talk about the basics of pairs trading in case it's maybe a term that's unfamiliar for some people watching this video. The term really came out of the technical analysis sphere. Technical analysis practitioners that also use statistical analysis to try to come up with market neutral trading strategies, meaning that the strategy could work whether the broad market went up or down. Specifically with pairs trading, the idea would be that you would look at highly correlated securities and wait until they suddenly became uncorrelated. The strategy would then tell you to basically go long the underperforming security and short the outperforming security until they basically came back to their historical mean in terms of their correlation. So that was sort of the idea. I, for one, am not a technical analysis practitioner by any means. I do not use correlations or statistical analysis in my screening criteria. I'm a fundamentalist first and foremost. So, but at the same time, I can see how a pairs trading strategy or a market neutral strategy could help in terms of a certain thing I like to deploy at times when I do see opportunities arise. In other words, it could be a tool for my toolbox, not that I want to grip onto it tightly and run around chasing anything that might look or feel like an opportunity, but rather wait until I come across something that might be opportunistic if I were to deploy the strategy in terms of my whole portfolio. So that's kind of the background and where I might or how I might selectively use it as a strategy for myself. So in terms of how I might apply this strategy, I guess first and foremost, as I'm seeing economic data weakening across North America in particular, but the globe in general, I've sort of wanted to remind myself of this strategy as sometimes when things start to weaken, opportunities can obviously present themselves, and different strategies may be deployed to again even protect yourself further in terms of volatility and uncertainty. So for me, unlike the traditional technical analyst approach to this strategy, I prefer to find companies that are within a single industry or sector, one being the leader, one being the laggard in that industry or sector, preferably as cyclical industries or industries that are tied to a commodity, just because they show a fair amount of volatility. I prefer then to go long the leader and short the laggard, basically only after an event-driven market sell-off or a sector sell-off, or maybe even commodity-driven sell-off if that's what I'm focused on. So once that sell-off has basically occurred, that will usually weaken both companies, but also narrow the gap between the two. and then enter the position at that sort of point, or even as it's recovering. And what I'm then betting on is the gap between the two actually will widen. And of course, if the event that drove the sell-off is particularly hurtful to the laggard, then perhaps that company in the pairs trade is weakened to the point that it may not recover to its former glory, or potentially at all, making the trade even a better trade-off. The reason I would prefer to wait for a market or economic driven sell-off is simply the fact that it usually proves to be a higher certainty or higher probability that the trade will pay off. I've not seen it work as well the other way. So that's my own approach, obviously, and I focus on companies as opposed to other types of securities, say commodities or other things like that. Again, I focus on the equity market, and of course that is my focus. In terms of the actual weighting of the trade itself, I prefer to dollar weight the trade. In other words, however many dollars I have long, I also have short, so that if I'm 10,000 long, then 10,000 short. I don't like to go kind of outside of that. Otherwise I'm kind of betting on one way or the other, and I don't think I'm that good at that, quite frankly. So I leave that kind of particular decision making out of the trade entirely, and just keep it evenly weighted. So hopefully that gives you some indication on how I look at pairs trading. It's not the traditional focus at all, but of course there are things you do have to be aware. And as mentioned at the start of this video, this is really an expert level only type strategy. If you're not familiar with short selling, a few little things to be aware of. If you are able to find a broker to lend you a security to effectively sell short, there are a few things you should be aware of. Number one, they are probably going to ask for a certain amount of margin, usually at least 50% above the initial position size of the trade itself on the short side. They're also going to be charging interest on effectively what is a loan in their eyes, and hopefully that interest rate isn't too high. And thirdly, if there is a dividend involved, so if it is a company and the actual owner of the security is owed a dividend, then the short seller will be responsible for paying that dividend to the effectively lender, and then ultimately the person that actually did basically lend the security to the short seller. So those are things that will be paid out no matter what. And then of course, if the trade goes terribly wrong, you will not only have all of that on top of you as a short seller, but also the trade going wrong will cause you to lose whatever monies you may have had the opportunity of gaining, plus you still have a loan to repay. So it's very, very risky, not for the amateur, and like I said, do make sure you get expert level advice if you have never done this before and think that it might be for you. Another alternative, of course, is also to try paper trading this type of transaction. There's a lot of online tools that are available for free, basically allow you to set up trades without any money on the table, so you could actually practice before you actually pull the trigger and try this for yourself. But just be aware there are some other fees and expenses associated with everything, assuming the trade goes the right way. So again, hopefully that was helpful. So that's what I wanted to share with you today on pairs trading. Again, I don't necessarily take a conventional view of this trading strategy, but see that it is a potential tool in my toolbox as I look at opportunities in the broader markets. So if you did like the video, please hit the like button and give me a thumbs up. If you are not yet a subscriber but want to see similar content, please by all means hit the subscribe button. And if you want to share with me maybe your take on this strategy or others in terms of risk mitigation, then by all means hit me up in the comment section with your thoughts, views, questions, concerns, or ridicule if that's your thing as well. Until next time, thank you very much for watching.